Question 51. Which of these probability distributions is most likely to be used to model stock prices? We've got a normal distribution. So we can rule out a normal distribution since stock prices can't go negative, and in a normal distribution we would have some negative prices. Distribution kind of looks like this, and then you'd have 0 in the middle. So you would have some negative, and so we could use a normal distribution to model stock returns, since returns can be negative, but the prices themselves can't. B, log normal. So in a log normal distribution, this is where stock prices can't go negative due to the calculation of that. So log normal could be our answer as of right now. Let's make sure we can rule out C and D though. And so for C and D, we've got binomial and Poisson. And so in both of these instances, these are going to be have some type of kind of discrete component to them, which means that the stock price is going to kind of jump or move in kind of set increments. So it might be whole numbers or half numbers or something like this. Whereas stock prices are going to be pretty fluid. It can be any number, really any number above 0. So for that reason, we're going to be able to rule out C and D, and we will stick with B, log normal. Question 52. Amelia Stone plans to retire next year and is considering an investment that would help to ensure her future financial stability. On average, Stone spends $70,000 annually. After retirement, she plans to relocate to the countryside, a move that should cut her living expenses by 20%. She was approached by her broker with the idea to start investing in perpetuities. Specifically, he suggested a perpetuity that would yield 7% per year. Assuming the mentioned reduction of costs, how much should Stone invest in the perpetuities to meet her spending needs? So what we're going to be doing here is we're going to take those spending needs, which is going to be $70,000 multiplied by the 20% reduction. And then we're going to take that number and we can divide that by a 7% yield. And that's going to give us the amount we would need to invest in order to meet our living expenses need per year. So it's going to be pretty straightforward. Our spending needs are going to be that $70,000 times 0.8 for the 20% reduction, gives us $56,000 per year. And then the perpetuity will be $56,000 divided by 0.07, gives us $800,000. So looking at this a different way, what this is basically saying, if we invest $800,000 in this, we're going to earn a 7% return per year, and that's going to spit off $56,000 worth of income every year. So we'll be able to live off that in perpetuity, assuming expenses don't change, without touching that principal. So we've got A, $800,000, and looks like that's our answer right there. Question 53. An investment bank has a $1 billion USD portfolio of senior unsecured loans evenly distributed between 10 different clients, each with an internal rating of B. The CRO of the bank wants to stress the loan portfolio under a scenario of an economic slowdown with GDP dropping by 2% and unemployment increasing by 1%. Based on the prior experience, the CRO knows the economic slowdown scenario will negatively impact the credit quality of borrowers and lead to a rating deterioration from B to C for half of the clients. The recovery rates of senior unsecured facilities are assumed to be 60% in normal conditions and 40% in stress conditions. So we've got credit ratings here and then their corresponding PD, which is probability of default. What is the bank's loan portfolio expected loss in both the base and the stress scenarios? So our expected loss formula is going to be that loss rate, and then we're going to multiply that by the portfolio. So our loss rate will be probability of default, which we are given, and then we're going to multiply that by loss given default, which is going to be 1 minus our recovery rate, and we're given recovery rate here. So we've got recovery rate of 60% in normal conditions and 40% in stress conditions. So for our base scenario, we're going to be using this 60% for recovery rate. And so that's going to be this portion here. So this is going to be our loss given default, 1 minus that recovery rate. And then probability of default is given right here. We've got internal ratings of B and 3% probability of default. So we'll take those numbers, multiply it by our full portfolio, and we get $12 million. So we see we've got that here for answer A and B, so we can rule out C and D right off the bat here. And then under that stress scenario, there's going to be a couple keys here. So the CRO knows we have a rating deterioration from B to C for half of the clients. So now we're going to be splitting this portfolio of loans in half for what we're kind of multiplying by for expected loss. So in the case of the half that stays with a credit rating of B, we're still going to multiply that by a probability of default of 3%. But then under the stress scenario, that recovery rate drops. So our loss given default is going to increase from 0.4 to 0.6. So we're going to do 1 minus 0.4 here, and then we're going to add that to the other half of the portfolio, which is going to have a probability of default of 25% since they're migrating down to credit rating C. And then that's going to be multiplied by that same recovery rate of 1 minus 0.4 in the stress conditions. And when we add that up, we get 84 million, which is going to correspond right here with answer B. Question 54. Over a 15-year period, the manager of a certain fund used a covered call strategy in an attempt to increase the return of the fund. The mean of the 15 portfolio returns is 0.0519, and the minimum acceptable return is 4%. Given that the downside deviation, as measured by the standard deviation of returns below the target, is 0.0017569%, compute the Sortino ratio. So this is going to be pretty straightforward. We're given all of the variables we need here. So we're going to be doing the mean of the portfolio, and then we're going to subtract out that minimum return. And so that's going to be in our numerator, and then our denominator will be the downside deviation. And so that's what our formula is going to look like right here. And when we work that through, we end up with 6.77, which corresponds right here with answer A. Question 55. Which of the following investment strategies does an equity market neutral fund follow? So we've got A, long short equity. That could be our answer so far. In equity market neutral, the point of the fund is to be market neutral. So in order to do that, they're going to be taking long and short positions in different equities to get the beta of that fund down to 0. And hope to profit off of the kind of pricing differences in those equities that they're going long and shorting. So A is looking like it'll probably be our answer so far. Let's make sure we can rule out these others though. For B, dedicated short, if we're dedicated short, we're going to have a negative beta. We're not going to have a beta of 0, so we can rule that out. We won't be taking any long positions to offset those short positions. Merger arbitrage, we will be going long short, and the beta of that could hover around 0, but the point of the merger arbitrage is not to be market neutral. It's to profit off of the differences in the stock prices between target and acquirer when those acquisitions are happening. So we can rule out C. And then convertible arbitrage, this is going to involve taking long positions in bonds and short positions in the company's stock to earn some profit there. So this is not going to be market neutral. That's a different type of strategy. So we will stick with A, long short equity. Question 56. Frank Ort is a junior trader at the options trading desk of an investment bank. He is reviewing a recent analysis of Tempo Construction LLC. Stocks of Tempo are currently trading at $47. According to the bank's analysts, the price of the stock will either go up or down by $8 in 1 year, depending on the revenues that the company will generate. Since Ort is quite pessimistic on the future development of the company, he is thinking about opening a short position by buying put options on Tempo's stocks. With a strike price of $45, the risk-free rate is assumed to be 2.1% per year. What is the no arbitrage price of the option that Ort is looking to buy? So we're going to be doing a binomial tree option here. So we're currently at $47. We're either going to be up 8 or down 8. That strike price will be important for determining that option value. So essentially we're going to look at what the option value will be in an up scenario and a down scenario. And then we're going to need to calculate the probability of an up move and a down move. And then we're going to take those two figures, weight them by their probabilities, and then discount them back to the future. So let's start walking through what that looks like. Let me get some of this red stuff off the screen. Let me just move this let's move this down a little bit. Okay, so the first thing we want to do is we're going to be calculating the probability of an up move. So the probability of up move is going to be we're going to take that risk-free rate and find out the continuously compounded rate for that. And then we're going to subtract out the magnitude of a down move. So magnitude of a down move is going to be the price in 1 year divided by the current trading price. So we can see that calculated right here. It's going to be 0.8298. And then the up move will be the probability or the magnitude of that up move. So 55, the price in a year, if we go up by 8 divided by 47, current price. So we've got those three variables right here. And then we plug those in, we get a probability of up move of about 0.56. So the probability of a down move is going to be the inverse of that. So these are going to be used as our weightings for these option values later on. So next thing we need to do is figure out our option values in either of these scenarios. So in the up move scenario, we have a price of $55. So the option value, since this is a put, is going to be 45 minus 55, so negative 10. So since this is a negative value, we won't exercise this, so the value is just going to be 0. And then in the down move scenario, this is where our put option makes money. We have 45 minus 39, so our value is going to be $6. So that expected payoff then is going to be these two values weighted. So it's going to be this $6 weighted by the probability of that outcome happening, which we can see right here. And then we're going to add that to 0 times the other outcome. So this second portion is just going to be 0. And that gives us an expected payoff of 2.62596. And then the last step here is we need to discount that back to the present value using that risk-free rate continuously compounded. And when we do that, we get 2.5714. So when we round that, that'll be closest to answer B. Question 57. An ordinary least squares regression produces the following. So we've got these three outputs right here. What is the coefficient of determination for the regression? So the coefficient of determination is another word for R squared. So let's pull in the formula we will be using for that. So we're going to be looking at 1 minus the sum of yi minus y hat. And that's going to be squared. So that is given right here as this value. And then we're going to divide that by the sum of yi minus y bar, which is going to be given right here at 58. So pretty straightforward. We're doing 1 minus 10 divided by 58. Make sure you use your parentheses for these values right here. And that gives us 0.828 for R squared, which is going to be right there, answer C. Question 58. Which of the following statements best describes a key difference between exchange-traded and over-the-counter markets? A. Exchange-traded markets offer greater customization of contracts compared to OTC markets and negotiable terms. So this is going to be flip-flopped. OTC markets offer greater customization and flexibility. Exchange-traded markets are going to be more standardized. So we can rule out A. B. OTC markets provide centralized clearing services that reduce counterparty risk. This is also going to be incorrect, and that's because this is a characteristic of exchange-traded markets. OTC market participants are trading directly with one another, so they don't reduce counterparty risk, they actually increase counterparty risk. C. Exchange-traded markets enhance liquidity and price transparency compared to OTC markets. This is going to be accurate, and that's a function of a couple of things mentioned up here, that they are centralized, and there's going to be less customization, so standardization of contracts, and there's just going to be more participants in this market. D, OTC markets guarantee execution of trades through a regulated clearinghouse. That's going to be incorrect as well. Same thing that we established up here. There's no centralized party in that case. Answer C. Question 59. You've been given the following information. So we got a bunch of information here. Looks like on a European call option, so we've got the price, maturity, strike price, current price of the share of the stock, expected dividend, and risk-free interest rate. What is the price of a European put option that expires in 6 months and has a strike price of $42? So we've got the same strike price as up here, but we're looking at figuring out the put option price based on all of these call option features. So we're going to be using the put call parity formula to calculate that. So once we rearrange, this is what that formula is going to look like. So the price of a put option is going to be equal to being long a call plus the strike price discounted at the risk-free rate of interest continuously compounded, and this is going to be that bond component, the risk-free component, and then we're given that dividend. So since we're going to be long the put, we're going to need to add that dividend in, and then subtract out the price of the stock, the current price of the stock, which is 38. So when we plug in all of those numbers, we've got 1.5 for the call, 42 for the strike, discounted back, and we're doing 6 months. So we're doing 0.5 on that discount, the risk-free rate discount. And then we're also going to discount that dividend back by the same, and then subtract out the current price. We get $5, which corresponds right here with answer A. Question 60. Which of the following bond is the cheapest to deliver if the Treasury bond futures price is 100-08? So we've got 4 bonds here. We've got their prices quoted and their conversion factors. So we're going to run calculations on all of these, and then we'll be able to figure out which is the cheapest. So our formula here is going to be our quoted price, which is going to be the price given right here in this column. And then we're going to subtract the futures price times the conversion factor. So conversion factor, pretty straightforward, given right here. And then the futures price is given right here. And so just as a reminder, these quotes are all in 30 seconds. That's how the Treasury bond futures are quoted. And so we need to do, you do the second number divided by 32 to get the actual price. So in the case of this 100-08, we're going to do 100 plus 8 divided by 32, which is 0.25. So that's how we come to that number. So pretty straightforward here. We're going to run this through on all 4 bonds. For bond A, we get 1.815. For B, we get 2.02. C, we get 2.65. And D, we get the lowest number, 1.5303, which means this will be our cheapest to deliver. Answer D, bond D.